Moving averages are a way of ironing out what might be termed the noise of a graph. Charts can sometimes seem very, very jagged, complex, difficult to distinguish what exactly is going on if they're moving up and down with great volatility. That applies to a day chart, a week chart, and a month chart. If the high-low close is plotted on a daily, weekly or monthly basis, there can sometimes be an awful lot of what might be termed visual noise that stops you seeing exactly the shape of the trends involved. Moving averages are first and foremost a way of smoothing up that price action to reveal the underlying trends and patterns within a period of time, as I say, whether it be monthly, weekly or daily. What you need to remember about them is how they're calculated. A simple moving average smooths out a chart and establishes a smoother line, but rather behind the price action of the underlying chart. What you need to remember about moving averages, though, is that in that creating a smoothed version of the original price action, the actual price action, the smooth version it's a delayed representation of it because of the arithmetic of creating a moving average. Means that when the underlying chart starts moving upwards, the moving average only shows the smoothed version of that complex and difficult to entangle piece of price action happens later on the chart. There have been ways of dealing with this whereby they work out the moving average and then bring it back to smooth it. These are complex issues which you should look very carefully at before you start relying on moving averages for signals, because they tend to give delayed signals. Indeed, they may be so delayed that they're too late to trade. Moving averages is a rolling average of X number of days. So, for example, if you've got an underlying day chart, you might take the average of 10 days and you move it along one day at a time. And that average, of course, is far less responsive than the underlying price action would be. So you go 10 days. 10 days, the first one drops out, you take another one. So that what you're doing is an average of a 10 days segment. If you make an average of a 20-day segment, that would be even smoother. An average of a 30-day segment would be even smoother. Incidentally, the longer the segment, the greater the delay of the smoothed out impression of the underlying.